When we talk about auditors, what is the first impression that springs to your mind? Troublesome, or even evil may be some of the answers. But why is that? In this new corporate governance series, our first topic is Auditors, Unsung Heroes in Corporate Governance. Pooja SHUKLA, senior lecturer from Hong Kong Metropolitan University's Shau School of Business and Administration, will discuss what auditors actually do and their important role in corporate governance.
Welcome to our first seminar of the series. We have chosen a very interesting name for this seminar, and we will discuss why this is important. I have been in Hong Kong for the last 10 years, but sadly, I don't speak much Cantonese. I do speak maybe around 5 or 6 words of Cantonese, and I have a favorite word. That word is an adjective, and I think it is a universal adjective. In a way, whenever you try to have a small talk with someone and you use that adjective on someone, people tend to either agree with you or laugh. The word that I'm talking of is ma fan. Ma fan in Chinese means troublesome. So you can say, my neighbor is troublesome, my team members are troublesome. But there is one set of professionals, whenever you are talking about them and you call them ma fan, you guessed it right. I'm talking about auditors. You say, my auditor is ma fan, and guess what? Everyone invariably agrees with you. So why is that? What have auditors done? What is wrong? Either something is wrong with us or something wrong with them. Or maybe there is something in the system. What have auditors done to have this kind of hatred amongst everyone? I'm sure you have seen movies. The latest one I can remember is The Wolf of Wall Street, where the company, the senior management, treats the auditors in such a bad way, which kind of sends a message as to how much in the professional world the profession of auditors is hated. And in this seminar, we are going to talk about this, hatred. The topic of today's seminar is Auditors, the Unsung Heroes in Corporate Governance. As the saying goes, well, actually the saying does not go, but let us create the saying, love thy auditor. Whenever I'm talking to my students who are working adults, they always tell me, oh, I hate my auditors. They are the corporate cops. They are very, very mafan. They are evil. They are the revenue killers. They stop me from doing my work. They are always questioning me. They're always imposing restrictions as to what I do, how I do my books, how I write my resolutions. They are lawfully stupid. I'm sure right there, sitting in your seats, even if you are an auditor, you might agree with all these allegations. But what is the reality? Why is this profession, why is this function of auditing hated so much worldwide? So the question is, should your auditor be nice to you? Which means if you think your auditor should do what you ask them to do. Should your auditors fit into your personal expectations? Should your auditor be by your side? Should your auditor work towards your personal interest? So my answer is, if you have an auditor who does all this for you, you should change your auditor. Why should you change your auditor if your auditor is too loyal to you? If your auditor is cooking up your books as per your taste, that is going to lead to misleading financial reporting of information. It is going to increase the mistrust amongst the stakeholders. Remember, trust is the most difficult thing to build, but it is the simplest and easiest thing to lose. When the books are cooked up, the relationship between the managers and the shareholders suffer. As you know, as per the agency theory of corporate governance, the senior management or the directors work as the agents of the shareholders. And if that kind of trust is lost between the principal and the agent, it is going to create problems in the smooth functioning of the corporation. If the audit function is not done properly, it is going to lead to the board failing to perform their duties because the information that they are working on, the pretext, the fundamental database on which they are working on is not correct. And hence, information garbage in, garbage out. So if the information input is incorrect, the information output is obviously going to be as troublesome. There are going to be unreported frauds if you are continuing with your auditor helping you to achieve your desired results. The internal control systems, the risk management system, they are put into place so that this whole system supports each other. The whole system, the functions are supporting each other. But if the financial statements, the financial reporting systems are cooked up, of course, it is going to be disastrous, not just from the financial perspective, but also from the operational and other legal and other functions of the company. Now let us discuss this beautiful relationship between the auditor, the company, and the shareholders. The auditors are responsible, they are accountable to the shareholders. They are, in principle, appointed by the shareholders. Then we have the company, we have the directors who are also appointed by the shareholders, and they are accountable in terms of how they run the business. They are also responsible to earn a good profit for the shareholders and a good return on their investments. So the auditor and the company, they have to work together so that the final output they produce to the shareholders develops trust, and the result is able to satisfy the shareholders. Now, the problem arises because the company directors, the managers of the company, they want to maximize their profits. Of course, who does not like a big bonus? And they see auditors as a threat because the auditor is going to question every single transaction if the company directors have owned the transaction or not. And the auditors, this kind of attitude of the auditors, company does not like. Who likes someone picking on you? Who likes questioning when you are directed by the shareholders to focus on your profits? Traditionally, this had been the approach because the auditors were responsible only to shareholders. But in the modern world, the auditors are responsible not just to the shareholders, but to the whole set of stakeholders. Now, this kind of triangular relationship between these three parties creates a very interesting love triangle where one party loves or tries to appease the next party while trying to be not too annoying to the other party. Because remember, if auditors are always just going to be too loyal, too straightforward to the shareholders, remember it is the company directly, not directly, but indirectly responsible to decide on the auditing fees, what kind of job the auditor will be doing, the scope of work, and any kind of other services, maybe consultancy, if they want to hire the same auditor or some other auditor. So I hope you understand this kind of triangular relationship where these three parties are interdependent on their relationships. So now let us discuss why auditors who are hated by everyone, what is the value addition they do in the corporate governance. They represent the interests of shareholders and stakeholders. If they did not do that, imagine if your shareholders leave everything up to the company, there are chances, because of the principal-agent relationship between the company and the shareholders, maybe they can be friends with the auditors and both of them can mutually decide on what kind of profits you want to show, which will please the stakeholders, which will please the shareholders. So it is very important to have this layer of filter so that one party can clearly see the outcome if someone is too loyal between a set of two parties. The auditors promote accountability. So this is why all the disclosures that we have in the system of corporate governance, they become not just a paper formality, but a real accountable action. All of this is because of auditors. Imagine if they did not, let's say if I'm doing any disclosure, which is basically on paper, the way I am drafting it, the legal language, if it is going to reflect that in my accounting transactions really or just on paper, that auditors can give their opinion on. Auditors also help in the crisis management because they are able to inform shareholders about any kind of hanky-panky things going on in the company, or if there is anything brewing which the shareholders may not be aware of. So they are kind of assistants of shareholders to keep their investments safe. Trust building. I'm sure for simple activities like going to the bank, if you are a company, if you go to the bank, they ask for a lot of documents, one of which is your audited balance sheet. Am I right? You may have to submit your BRC, you may have to submit your certificate of incorporation. All of that is backed by the government. But when you are talking about balance sheet, it is backed by your auditor. So I'm sure now you are able to see how much of trust the government has put on this profession of auditors to keep on the process of corporate governance. Risk assessment, this is one of the most important roles of the auditors currently when they have to assess the process inside the company of risk management, mitigation, and what kind of planning of risk is in the process of the company while they prepare the financial statements. Now let us discuss the most important part of this seminar, which is the independence of auditors. If you have basic knowledge of corporate governance, you would understand that the role of independence when it comes to non-executive directors or any other third party giving any kind of view about you, or even board evaluation, how much of the factor of independence plays a role. So now let's discuss the role of independence when we apply that to our auditors. Do you think your auditors should be independent? The first and most important thing is there is a legal obligation to be independent. So even if you decide, no, my friend is an auditor and he will give me a big discount on the auditing fees, let's continue with my friend. The law says if your company accounts are audited by an auditor who is not independent, it is going to create doubts in the minds of the shareholders and the stakeholders. So the auditors also help you to improve the credibility of the financial statements. Okay, let's do this test. You go to the bank, you take two versions of your financial statements, unaudited and audited. And I want you to tell me which one do you think the bank is going to accept. It is very important to have this protection of the profession, of the respect or the reputation the profession of auditor has internationally. That is why even when you are opening a subsidiary in another country, even the regulators there ask you for an audited balance sheet. What does it show? That your auditor, his word is so much of weight that even another country is relying on this person's expression of opinion. And most importantly, The role of an auditor is to be a watchdog so that the relationship that we have between the shareholders and the company directors is not compromised. Now let us discuss the case studies. By now, maybe you are not so convinced by my words as to how important auditors are. So let us see what happens when your auditors are not Mafan. I'm sure you have heard of this case, Enron. In the early 2000s, it was a very big name. Such a big name that people compare it to Microsoft in terms of revenue. It was a very big company. It was, for most of the people, it was their dream to work in Enron. The company grew so much and so well that it became like a dream come true for anyone who got the opportunity to be even connected with Enron. Their auditors were Arthur Andersen. Just to remind you, they were also working as their consultant. This topic we would discuss in the later slides. If you see the figures, you will probably not even believe. The share price of this company went from US dollars 90.75 to 26 cents. It all happened overnight. It just so happened that people were not able to believe it. They had cooked up their books in such a way that they had booked their losses into special SPVs, special purpose vehicles, and they had also falsified their balance sheet to the extent the cash that was never there in the company. And guess what? The auditor was not able to detect that. The auditor was too nice to the company, and as a result, the company fell. So now I hope you understand what happens when your auditor is too loyal to the company directors, when the auditor is too shy to report the frauds. The other case is Satyam case. It was an Indian company and it grew so much within a span of few years. It started as a company of, I think, less than 10 people, and then it went so big that most of the IT people wanted to work for Satyam or were working for Satyam. I still remember the days. This is like a personal story to me. I still remember I was working as a company secretary for a listed company at that time. And during my lunchtime, I just opened my computer to read the news. And my eyes could not believe it. We saw the personal letter that the director of Satyam had written, apologizing for whatever he had done. It felt like it was a joke. Maybe someone has hacked some account and wrote that letter by mistake, and the company really did not want to send that letter. So you can imagine the shock, and I was not even an investor in Satyam. Imagine if you were an investor in Satyam, how you would have felt when the directors apologized to you for cooking up the books. They had created fake bank statements. They had simply printed that from their computer. And guess what? The auditors, PwC, they never checked those bank statements. This had been going on for the last 10 years in Satyam, and the PwC auditor were not able to detect that. Finally, Merrill Lynch, they came on board and they detected all of this fraud in mere 10 days, what Satyam auditors, PwC, could not detect in the last 9 to 10 years. All of these things create a kind of doubt in the mind of shareholders or the prospective investors whether corporate governance is really a function or if it is just a sham, because the company had been, doing all the compliances required by the regulators. And then finally, the regulators, they banned PwC for 2 years. And it was a big thing because at that time, PwC was, and it still is, one of the best fours in the world. That reminds me, even in the case of Enron's auditors, at that time, it used to be, whatever I have heard, because I was too young to remember those things. At that time, it used to be 5 Big Five, and because of them leaving, it now became Big Four. Those auditors, Arthur Andersen, are still running their consultancy branch in the name of Accenture, but they are not doing any more auditing. So you can imagine when your auditor is too kind to you, eventually it is going to definitely blow up. Akai is an interesting case study because this showed the negligence of the auditors eventually costed the company so much that the liquidator even sued for falsifying the legal evidence. They had been destroying the legal evidence when the court cases started. And eventually, Ernst & Young, who were their auditors, they decided to pay an amount to the company. And all of these issues cast a big shadow on our belief in the system of corporate governance or the process of auditing and the trust or the reputation of external auditors. But I want to remind you that a few bad apples should not make you have this kind of disbelief in the whole system. Now let us see if things really changed after Satyam and Enron. As you can see, the measures of effectiveness were further imposed to see what will be the result later on. They increased the number of audit committee directors. The proportion of independent directors more or less increased, or I should say remained the same. They had a little bit more number of audit committee meetings, and the attendance at the audit committee meetings more or less remained the same. So if we impose these kinds of set of standards, is corporate governance going to improve? The answer remains, how much of corporate governance practices do you believe in? If you believe on the paper practices of corporate governance, I have to tell you, nothing is going to change unless corporate governance practices are followed in spirit. Creating paper tigers, creating paper auditors are not going to have a big impact, rather a negative impact on the profitability and the reputation of the profession. Now let us analyze the 3 lines of defense model. As you can see, there are 3 lines of defenses that a company can create, and any company can do so. So the first line of defense consists of the management controls or the internal control measures. The second line of defense is the functions like your risk management function, inspection, compliance function, your financial control functions. And all these functions, these 2 functions, report directly to the senior management. Finally, we have the third defense, which is the internal audit. The beauty of internal audit is that they report to the senior management, and they also report to the board and to the audit committee. So maybe you have made your whole system so watertight that any kind of inconsistency will not fall through your gaps. So this kind of 3 filters are created so that any kind of issue should get caught in the first line of defense itself, or at least in the second, or in worst case, at least in the third line of defense. And finally, we have our external auditors to give their stamp of approval on this whole process of these 3 lines of defenses. It is very important to see how the external auditor will oversee as an independent person or would verify whether these systems were really put in place to contain any kind of issues or misfortunes. Since you are all students, I expect you to go through this newly came in guidelines, which came very recently, on the guidelines for effective audit committees, which governs the selection, appointment, and reappointment of auditors issued by the Financial Reporting Council. I encourage you to go through these guidelines. Now you would be wondering, what is the role of an audit committee? So the role of audit committee includes reviewing the financial reporting issues and the accounting judgments that the senior management or the accounting or finance department has been using. I want to remind you, accounting judgment is such a fluid concept where maybe as per your judgment, this issue should be recorded in the books of accounts in this way, whereas in my opinion, this issue should be recorded in exactly the opposite way. So when it comes to accounting judgments, there is a lot of kind of risk involved of whether they are recorded in the financial statements properly or not. So it is the responsibility of the audit committee to see the accounting judgments are properly used and are reflected in a way which is beneficial for the proper transparency in the financial statements of the company. They also oversee the internal control and risk management systems. They also have to consider if there are any issues that fell through the cracks of the defense model of the company, then it is the role of the audit committee to decide whether in this kind of situation any investigation is required or not. They have to coordinate between the internal and external auditors. Now imagine what will happen if audit committee was not there to see internal and external auditors. In the absence of audit committee, it is very likely that over a period of time, internal and external probably either would merge or internal auditing would become so outdated or inoperative or would be taken over by the senior management or the accounting department or the CFO that it will have no value at all. They have to ensure a timely response to the issues raised by the auditors, and they have to see the independence of the auditors and the effectiveness of the auditing process. As we discussed, how important it is to have the auditors remaining to be independent throughout their tenure in the company. It is the responsibility of the audit committee to see that they remain independent throughout their tenure. And they also play a very big role in recommending the appointment, reappointment, and removal of the auditors, and also they determine the fees that you pay to your external auditors. For the purpose of this seminar, each time I use the word auditor, I would mean the external auditor unless I specify internal auditor. Now, what is the role of audit function in corporate governance? As you can see, that the whole function combined into as a team of audit committee, external audit, and internal audit, they are responsible or they kind of give rise to this at external level, the auditor's opinion, the trust building, and the transparency of the financial statements. Whereas at the internal level, they are controlled by the board of directors, or they are being directly responsible in terms of internal control, risk management, and financial reporting. Now let us see who attends audit committee meetings. Of course, it is the audit committee members who attend the audit committee meetings. But in addition to them, these are the parties that are invited. Of course, the external auditors, the head of internal audit, the finance director or any other department that you have which is equivalent to that, and your executive directors, because sometimes there are operational issues which are raised by the audit committee depending on the agenda that you have set, which can be specifically answered by the executive directors. Audit committee should also hold separate private meetings with the external auditors and internal auditors with no executive directors present. Why do you think that is a good practice? Sometimes it happens in the presence of people whom you report to or whom you have a professional relationship. Maybe you are not able to have a voice, but there are things that you really want to report. But having these kind of private meetings gives you a platform to be more open, to be more relaxed in terms of your communication with the audit committee, because your voice matters. Now let us see quickly what kind of framework of annual assessment can we create to make this whole process even more effective. So the role that in this case, we can decide whether the auditors can decide whether the information provided by the management was timely, clear, and complete. Because at the same time, when auditors are auditing you, there is a lot of back and forth of flow of information. So the culture of right first time is important. So as you save time and you are able to concentrate on the issues that you feel might have left out rather than correcting how the information should have been presented to you. You need to see if the audit committee is well kept informed about the development of the control environment by the management and by the internal audit, and audit process is properly well organized and efficient, and how well the management was welcoming and prepared when the auditors came in. Remember, when it comes to auditors, companies hate to see them coming, but they love to see them go. The other sample that we can use is when the auditors are rating the client. So the auditor, in this case, can say, the audit committee or the finance department can say that the audit partner was professional, was demonstrated audit quality, and had technical knowledge about this profession or the industry that the company operates in, and the scope of audit was clear and it was properly evaluated. In my professional experience, I have seen that when it comes to the scope of audit, that is the biggest hurdle, because that is when your management and your external auditor is deciding what kind of strictness or what kind of controls we are talking about. And it is very important to see the definition of quality that you see and your auditor sees are in line with each other. Now let us see what this research by FRC on the market report on the change in auditors, which was conducted for the year 2020, taking into account 237 listed companies in Hong Kong. This says the unable to reach an agreement on audit fees is the most common reason for resignation of auditors in Hong Kong. If there is any unresolved issue with the management and auditor rotation being the least. Let's quickly see the difference between internal audit and external audit. I have seen a lot of students confuse between internal audit and internal financial audit. Remember, internal financial audit is a part of internal audit. So what is the purpose? The purpose of internal audit is to improve performance, and it covers any aspect of business or operations, whereas external auditors are there to give their opinion on the financial statements if they are giving a true and fair view of the financial position of the company during that period. The goal of internal audit is to inform, whereas external auditors report. Internal auditors report to the board of directors or to the audit committee, and the external auditors, as per law, they report to the shareholders. Internal audit is a process which covers the current time or prepares for a time in the future, whereas external audit covers a time which typically the last financial year. The relationship is internal auditor may or may not be your employees, and sometimes it is even an outsourced function to your audit firm, whereas external audit function is an independent party and is appointed by the shareholders. Now, how to make the internal audit function more effective? You have to make sure that the internal auditor has the direct access to the board's chairman and the audit committee. The internal audit function must be accountable to the audit committee, and it should report to the senior management, but not to the CFO, so as to maintain that, I should say, independence. It is very hard to be a part of the company and still be independent, but that is the same level that we need to use or apply or resort to when we are talking about the internal audit function. The head of internal audit should report to the CEO so that information flows not through the channel of the finance function. The internal audit function should be free from the interference regarding the scope of work. Like I mentioned earlier, the scope of work is the most important thing to discuss, whether it is your internal audit or whether you are discussing any other consultancy from your external auditor. They have to avoid any type of conflict of interest and must remain unbiased and objective. Since they are a part of the organization, this is the most difficult thing to achieve. Now let us see the remuneration of external auditors. As per the Companies Ordinance of Hong Kong, under section 404, subsection 1, it is fixed by the shareholders by a resolution passed at the general meeting. The Corporate Governance Code, however, says that the audit committee should approve the remuneration and the terms of engagement. And they have to review the nature and scope of audit and the reporting obligations before the audit function commences. The fees, it should not be too large or too low. It must be kept at an optimum level to keep the auditors motivated to work for you, and at the same time, you should not make them too greedy that they forget that they are external auditors. Now, what is the challenge when we are talking about audit quality? The audit quality mainly relies on two factors: the ability to spot the fraud and the willingness to report the fraud. Probably I should say it is quite easy to spot the fraud. When you are analyzing the financial statements, it is quite obvious that you will come across things that are kind of evoke your suspicion. For example, if you have a lot of cash in your bank, then you might think, if there is so much cash in the bank, why is the company senior management not considering to invest it? Or why throughout this whole period of time that cash remained untouched in your banks? Willingness to report would depend on the level of independence you have in terms of how willing you are to report these to your shareholders. Because there is a chance that you and the company management have that kind of relationship where you both maybe go hand in hand. You want to secure your job, they want to secure their job. But it is the most important thing that the profession of auditor remains a reliable profession. So it is very important that along with the ability to spot the fraud, your external auditor must have a willingness to report that fraud without any bias. What are the types of external audit reports? The first is unqualified opinion. It is the clean bill of health that you are perfect, you are doing good. The second is the qualified opinion. This is also called except for report. So for example, you may say that the whole of the financial statements reflect a true and fair view. Maybe you have one issue, maybe on the process or the calculation of, let's say, depreciation on one particular asset with which you may not feel comfortable giving your opinion of. The third is the adverse opinion, which generally auditors give when there are material misstatements in the financial statements. These reports are very rarely used because that clearly shows that there is a big problem in your financial statements. And generally governments or the investors, they ask you to redo your financial statements and find another auditor to give the auditor's report. And the fourth one is the disclaimer of opinion. So this is a situation where, in true sense of word, your report is too mafan, where the auditor thinks that he is unable to give any opinion on your financial statements, mostly because maybe there is a big material conflict of interest, or there is a serious doubt about continuation of the firm or the company or the organization as a going concern. These reports are very rarely issued and are absolutely unacceptable by investors or the government agencies. So what are the types of rotation of auditors? We have audit firm rotation, where you, after a certain period of time, you want to appoint another audit firm. And the second is audit partner rotation, where you may continue with using the same audit firm, but you would want your partner to go and maybe another partner of the same audit firm to come in. The good thing about this is a more stricter regulation that you can impose on yourself. Of course, it is very beneficial to keep your auditor independent. In the second case, I think it is slightly softer version of rotation, but at the same time, in my personal opinion, in my professional opinion, I have seen that for audit partners, whenever new audit partners come in, they also bring their own team to work with the company, and you are able to see the same set of financial accounts with a fresher pair of eyes. At the same time, it is very easy to have a good communication with your current audit partner, and because he has the access to your other audit partner, and for any kind of exchange of information, I think it is kind of softer version of rotation. But if you are able to maintain that kind of independence within this rotation, this serves as a very good idea too. Now let us analyze if rotation of auditors is a good idea. Question is, what is better? If a shorter rotation period is better or a longer rotation period is better. If you analyze the laws across the world, a few corporate governance codes in Asia ask for 9 years, and some countries in the West, they ask for even shorter. And a lot of other countries, they do not ask for any rotation period. But in my opinion, for a better corporate governance, it is recommended to have rotation period. But depending on the industry that you are in, the type of company you run, you can decide on the period of your rotation. Will a newly appointed partner be more independent? That remains a question, because that depends on the skill and experience of your audit firm or your audit partner. When the new partner comes in, there is a high chance that this person will have reinvent the wheel all over again. So this person has to see whether the information that the previous auditor had, this auditor will not have that basis to start with, which may go in favor of the company or which may not go in favor of the company. Sometimes when the first auditor is leaving and the new auditor is coming, they do a cleanup of the client's accounts, depending on how messy they had been in the previous years. Whenever you want to do a handover, of course, you want to give the best picture, and you do not want the next auditor to complain or find out issues that you had been using, that you had created during your tenure as the auditor. Now let us see what are the threats to auditors' independence. Self-interest threat arises when your audit firm or your audit partner is interested in the company. For example, maybe the audit firm has some kind of investment in the company, or maybe you have not yet paid their auditor's fees yet. So they would definitely want to issue a favorable audit report to your company so that their interests are not jeopardized. Advocacy threat. There is a chance you have asked your auditor to also be kind of broker for one of your subsidiaries that you are looking to sell. And if your auditor gives you a favorable report, it would be easier for the investors to buy in your company. When you are too familiar with the company, their management, then familiarity threat arises, because you would take things for granted that I know this company, I know this senior management, I have been working with them for n number of years and I trust them. That way, you will not be able to be too objective or too independent when you are giving your audit reports. Next is this trust threat. Of course, when you're working with the same set of professionals in the company, you start having that trust relationship with them when you know that, oh, this is my golf buddy and I know this person is never going to do anything which is going to affect me or in a negative way. So trust threat arises when you spend too much time as an auditor with the same client. Next is intimidation threat. Maybe your client has told you that if you do not issue a favorable report to me, I'm going to kick you out next year. So you get intimidated. You face this threat of giving them a favorable audit report. Next is self-review threat. I have seen that happening a lot when the auditors are given non-audit jobs. What happens is your external auditor is reviewing the work that he has done. So this creates a self-review threat. So you cannot review the work that you have done yourself. Of course, even if you find out problems in your own work, there is no way you are going to report it because professionally it is going to look bad upon you. Now let us see how we can safeguard ourselves from these threats. Rotation of audit firm or audit partners, prohibition to serve as a director or audit committee member or officer of an audit client. In this way, when you stop your auditor to become a part of your organization, it would be easier for the auditor to remain independent. The safeguards in the work environment of an audit firm. Sometimes the audit firm is strictly complying with its own policy to maintain that level of independence with their other clients. Safeguards created by the profession, legislation, or regulation. In Hong Kong, we have certain codes that the accounting professionals follow. And we also have the same thing in the law to protect them from becoming too dependent on their client. We can also regulate the non-audit services that you offer to your client. The Code of Ethics for Professional Accountants by HKICPA says when your audit fees is more than 15% of your total audit fees for 2 consecutive years, then the audit practice must disclose this to the people who are responsible for the corporate governance function and consider the safeguards to reduce this threat because clearly you are too dependent on your particular client. The key audit partners should rotate after 7 years. And the key audit partners should not be a member of the engagement team for the 2 years following the rotation. If you are an accountant, I encourage you to go through this code of ethics. So basically, in terms of ethics, auditors' independence is crucial to give out an independent opinion. And the professional accountants are expected to abide by their professional body to act with integrity, objectivity, and follow the code of ethics. Now, quickly, let's see what are the tips to achieve greater auditors' independence. Achieving real independence is the key. Being independent in fact and appearance, a lot of the times it is seen that people are able to prove independence even when they are not independent. Understanding the regulatory requirements of independence in foreign subsidiaries. My suggestion in that case is if the foreign subsidiaries have a higher level of independence requirements, then companies should opt to impose that on themselves, even if in their home jurisdiction that requirement of independence is slightly softer. This way you will be able to self-regulate yourself at a higher level of independence. You have to consider all the relationships between the audit firm and the management that affect the independence, and seeking updated policies of audit firm, including their incentive policies for partners and senior staff, would help you to understand how the progression of this whole process of audit function is aligned with their incentive policies, and you will be able to see whether this audit firm at this point of time is independent or not for you. I should use the word enough independent for you. Now let me ask you this question. Should your auditor provide you non-audit services? What do you think? Let's see what the law says in Hong Kong. As per the Corporate Governance Code in Hong Kong, the company has to provide an analysis of nature of services and the fees paid for the audit and non-audit services in the corporate governance report. And the Code of Ethics by HKICPA says that before the audit firm accepts the engagement, they have to provide non-audit services. A determination shall be made if this would create a threat to the independence. And finally, the audit committee has to ensure that providing such non-audit services would not impair the independence of the audit process. The SOX 2002 imposes much stricter rules, and as you can see, the timings of SOX coming in and the Enron case. I would say more or less this is a parting gift by Enron to us, where this regime imposed serious restrictions of the auditor providing you non-audit services. This is the list of services that are prohibited. Tax services are specifically allowed by the Act, subject to the approval of the audit committee. So if your audit committee thinks that you may not be able to provide these services without losing your independence, then it is up to them to decide. And I have to say that this kind of provision remains the same in the context of India too, because India also follows a very strict regime for independence of auditors and directors. Now let us see the rights of external auditors as per laws in Hong Kong. They have rights in relation to general meeting. They can attend the general meetings. They also have the right to access the information and accounting records. And the outgoing auditor has the right to provide information to the incoming auditor in good faith. And finally, the legal professional privilege defense, where if an auditor is providing any type of information during the course of his being the auditor in the company as an auditor, then provided there is no malice, then he cannot be sued by the company for defamation. Now let us see what are the liabilities of the external auditors. They have a duty to care. They have a liability if they fail to comply properly with the professional audit guidelines and they fail to follow the due skill, care, and diligence which is required by them professionally. Further, they also have duties under law. Companies Ordinance of Hong Kong, Section 407 and 408 talks about this, and you might remember the claims of negligence in Akai Holdings case. Now let us see the new consultation paper in UK issued by the Department for Business, Energy and Industrial Strategy, which aims to establish clearer responsibilities for detection and prevention of fraud. And this covers the enhanced duties of directors, increased expectation from the auditors, and how to deal with fraud and conflict of interest. What should we follow to have a healthy audit love life? The first thing being finding the right match. The right audit firm is of crucial importance. When you have a right partner to work with, I think 50% of your relationship issues are over. You should be able to find out the audit firms that have the experience of working in the same industry or in the same jurisdiction, or sometimes even the practices that are working in foreign jurisdiction, and they are able to bring in an extra wealth of experience to your jurisdiction. You should be audit ready always. A lot of the companies face this threat when the companies always try to shy away from the auditors and they say that, oh, right now we are not ready for the auditing function. The way you are organizing your set of accounts and your policies shows how ready you are in terms of audit. So it is important for you to, throughout the year, think of every single moment that any time auditor is going to knock the doors and are you ready? If your answer is yes, you are doing your job right. Create, review, and stick to your policies. The policies that you create, if you automate them, then you will not have to manually make changes or update them. This will help you in the long run and help you to be auditor ready always. You should keep your data backup function, cybersecurity, and privacy and digitalization function updated so that you are able to welcome the auditors at any point of time without being embarrassed. So, do you love your auditor? If your answer is yes, this is how I would rate the success of this seminar. Thank you very much, and I hope you learned something new in this seminar today.